Hi, everybody. This is Accounting 4910, and this is Dr. Gregory. And this week we are going to go over two chapters regarding the consolidated financial statement and outside ownership and intra-equity asset transfers. So let's start with Chapter 4, Consolidated Financial Statements and Outside Ownership. Here is a consolidated balance sheet from General Mills, where we can see down in the highlighted area, we talk about non-controlling interest. And this is when we need to be sure that we put this into the balance sheet. It's also noted in the consolidated statements of comprehensive income, in the consolidated statements of earnings, in the consolidated statements of total equity and redeemable interest. And we can see also, if we look at the ACC4910 report for General Mills, it's also written on extensively in the notes to the financial statement. Now, when a parent doesn't own 100% of the subsidiary company, everybody else is considered what we call a non-controlling or minority interest. And it's non-controlling interest is any voting shares of an acquired company that the acquiring company doesn't purchase. So it's all the shares left over. Companies don't always purchase 100% of another company. They will usually take control of the company. And remember, we learned what control was before, where it is more than 50% of the company. Those that own the rest of it are called either, as I said, the minority interest or the non-controlling interest. And we have to perform consolidations in order to produce those consolidated financial statements. There's lots of reasons why companies don't own 100% of another company. One, maybe the parent doesn't have enough resources to purchase 100%, or some of the shareholders have have elected to retain their ownership. They don't go with the sellout. Some issues with the non-controlling interest portion is that their equity is recognized by the parent in the consolidated financial statement. And we use the acquisition method, which equals that the subsidiary is valued at the acquisition date using fair value. And it's fair value of the controlling interest and fair value of the non-controlling interest at the acquisition date. Now, we look at the controlling interest always first as the parent, and then the non-controlling interest when we are looking at the allocation of goodwill. And we allocate goodwill to the controlling interest for the excess of the fair value of its equity interests over the fair value of its net assets. And then any other remaining goodwill is allocated to the non-controlling interest. For example, the goodwill may be allocated based on a written agreement between the companies, or it could be based simply on the allocation of how much controlling interest the parent has. Now, if the fair value of the acquired firms is less than the collective sum of the identifiable assets, that means we purchased it at less than its fair value, then it's considered a bargain purchase. And the bargain purchase occurs and the parent recognizes the entire gain in current income. No gain is allocated then to non-controlling interest because the parent controls the company through its purchase, but in the grand sum of things, the value of that purchase is less than the fair value of the assets. So the controlling interest or the parent organization gets all of the gain. Now, if the price per share paid by the parent equals a non-controlling interest per value share, then they would recognize that goodwill proportionately. So what is consolidated net income? Well, consolidated net income includes 100% of both the parents and the subsidiaries' net income, but we have to adjust it for the acquisition date fair value over that book value amortization. And then once the net income is consolidated, we allocate to the parent company and the non-controlling interests. And the non-controlling interest share of that consolidated net income is limited to the share of the adjusted subsidiaries' net income. Now, when we are including the consolidation process worksheet, we have to think about 4 figures that we must calculate. One is the non-controlling interest in the subsidiary at the beginning of the year, that current year, the net income attributable to the non-controlling interest, if there is any, subsidiary dividends attributable to the non-controlling interest, if there is any, and the non-controlling interest as of the end of the year. And that is the 3 balances above in the description. And then we combine the non-controlling interest, the net income attributable, and the subsidiary dividends. All 3 of those combined equals the non-controlling interest at the end of the year. Now, when we're looking at the income statements and the balance sheets, we have to compute the consolidated net income at that combined entity level, and we allocate to non-controlling and controlling interests. And then we have to adjust the identifiable assets and liabilities that were acquired to full individual fair value at the acquisition date. We can't lump them all together as just total assets or total liabilities. We have to go through each account to their full individual fair value at the acquisition date. Now, in the financial statement called Changes in Owner's Equity, this financial statement provides the details of any of the ownership changes for the year for both the controlling and the non-controlling interests, and we allocate each component of the other comprehensive income or loss to both controlling and the non-controlling interests. When we have a mid-year business acquisition, we have the pre-acquisition revenues and expenses that are on the subsidiary's books. Then we have that acquisition. So in the consolidated financial statement, we only include the post-acquisition revenues and expenses on the consolidated financial statement. Why? Because they weren't consolidated pre-acquisition or before the acquisition date. Now, sometimes we have what's called step acquisition. And step acquisition just means that we have separate purchases of the subsidiary over time. We don't go out and purchase that controlling interest right away. Maybe we slowly, as the parent, purchase more and more shares of stock in that company until we have control. And then once we have control, we use that acquisition method and adjust all the prior investments to fair value and then recognize the gain or loss. So you might have a loss in this if we purchased shares early in the step acquisition point that were below market value. And again, we always go back to the fair value of the interest is what constitutes the control over the acquired company. So as we are having separate purchases of the subsidiary over time, We look at that fair value at that point of time when the parent takes control. Just as if we're doing step acquisition or purchasing control of another company, parents may also sell subsidiary investments. They just sell their ownership shares. When they do that, they have to create an investment account balance separate for the accounting of those sales. And then we adjust the parent's investment to recognize the income or amortization previously omitted only if the equity method has not been used. In most cases, equity method will be used. Now we compare the balance to the amount of received for the stock, and we record either an adjustment or that additional paid in capital. Remember, if we sell shares of stock greater than the value of those shares, then we would record that additional paid in capital. Now, if the parent no longer controls the subsidiary, they sell enough shares that they have lost control, we recognize that gain or loss when the parent no longer controls a subsidiary. Now let's talk a little bit about the intra-equity asset transfers. And simply what intra-equity asset transfers are upstream or downstream purchases or sales, transfer sales, where assets are sold from the subsidiary company to the parent or from the parent to the subsidiary company. Remember, one of the reasons why companies consolidate is to maybe gain additional inventory for their company. And so it's not an uncommon practice for the parent and the subsidiary to sell raw materials or assets between the companies. One company is going to record the sale, one company is going to record the purchase. So if it's from the subsidiary to the parent, the subsidiary records the sale, the parent records the purchase, and vice versa. Now, we have to eliminate those transfers within the consolidation because they didn't occur with an unrelated party. They were sales and purchases between the parent and the subsidiary. So you would be actually doubling up sales or doubling up purchases if you did not eliminate those transfers. And I have provided a document that provides some additional information on the FASB ASU 2016-16, which is intra-equity asset transfers between parent and subsidiary. As you can see, a lot of accounts are affected by intra-equity inventory transfers. It's just not sales and revenue. It's cost of goods sold, where the value of the purchase is posted. It's the net income attributable to the non-controlling interest. It's retained earnings at the beginning of the year. It's inventory, and it's non-controlling interest in the subsidiary at the end of the year. So a lot of accounts are affected by this, and you have to go through and adjust all of these accounts in order to clear out those intra-equity asset transfers. Now, intra-equity gross profit occurs when those transfers take place. And that gross profit should not be recognized because the inventory is now inflated, which results in cost of goods sold to be too low and profits are going to be too high. So an expense is increased by that inflated inventory value in a worksheet adjustment. So always go back to your examples in your text that removes that unrealized gross profit from the consolidated net income. Now, the ending inventory associated to equity gross profit requires an adjustment in 2 successive years from the ending inventory in the year of the transfer, that purchase and sale, from the beginning inventory of the next period. So we have to remove that overstatement from the beginning inventory of the company, and it increases the current net income as the adjustment of the beginning net inventory, as it is offset to cost of goods sold. So I'll repeat that again. We have adjustments that are required for 2 successive years. The ending inventory in the year of the transfer, which is the purchase and sales, we have to remove it and adjust the beginning inventory of the next period so that we remove the overstatement for beginning inventory. Because remember, ending inventory becomes beginning inventory. So you have to remove from the ending inventory at the year of the purchase and sale. Then you have to remove it again from the beginning inventory. And that increases the current net income as that adjustment of the beginning inventory is offset to that cost of goods sold account. Now, what is the effect on the non-controlling interest? Well, we can see ASC 810-10-45-6 says the intra-entity profit or loss eliminated doesn't affect the non-controlling interest. The elimination of that profit and loss is consistent with the assumption that the financial position and the results are now as a consolidated single entity. And the intra-entity profit and loss may be allocated proportionally between the parent and the non-controlling interest. Now, when we think about net income and the non-controlling interest, when we have a downstream transfer going from parent to subsidiary, parent sells to subsidiary, deferred gross profits relate solely to the parent company. There's no effect on subsidiary or non-controlling interest. If it's upstream, the sale goes from the subsidiary to the parent, that net income is attributed only to the subsidiary and not to the parent. Now, sometimes we have land transfers, and those land transfers that go on between companies, for example, the parent purchases the headquarters building of the subsidiary. And so now it's within the parent's financial statements. Land transfers are going to parallel those of inventory transfers. So there's a sequence of events that goes on during this transfer. Now, the original seller, subsidiary or parent, reports the gain of the sale of the land, and it's closed to retained earnings. The acquiring company, parent or subsidiary, usually the parent, will capitalize the inflated transfer price in the land account. And the gain on the original transfer is recognized as consolidated net income when the land is disposed to an outside party. So if we purchase the land and then in some future event, we sell the land to an outside party, that gain is recognized as consolidated net income. Now, don't forget to review both the text and the accompanying slide decks from the publisher for examples and deeper discussions. Have a great week.